Hello guys, my name is Behroz and welcome to my channel where I share with you financial and career success. Now in this particular video, I will share with you key differences between mutual funds, index funds and ETFs. You must have heard about these three key pillars of investments that are available, but you may be wondering what are the key differences. Apart from just sharing with you the key differences between these three pillars, I will also talk about which one is the right investment vehicle for you, which is the one where I invest and why I invest in that. So I will be explaining all of that. So make sure you stay tuned till the end of this video. Now, before I jump into the video, I have two asks for you. One, smash the like button as this keeps me motivated. Second, press the subscribe button along with the bell icon so you get notified as soon as I put a new content on this channel. On this channel, I talk about financial and career success. So make sure you put in your support with liking and subscribing to the channel, as this goes a long way for me, one, to stay motivated, and second, to improve the quality of the content that I post on this channel. Now you do your part and I will do my part, which is what are mutual funds, index and ETFs. Let me start by talking about what is the commonality between all these three, what these all three kind of investment vehicles stand for. They are cluster of stocks and investments. So let me explain by an example. In an old world, when you would want to go and invest in the stock market, you would buy one stock for a particular company. Let's say you buy a stock for Apple, you buy a stock for Microsoft, you buy a stock for Facebook, Amazon, Procter & Gamble. This way you bought 5 different stocks and you pay the price of the stock that is available in the market for those particular organizations. And you have to go individually buy those stocks and pay the fee for buying those stocks, the commission and whatever fees are involved. And you have to purchase them. Let's say you decide to purchase those 5 stocks. Now, instead of individually purchasing those 5 stocks, you can purchase a cluster of those 5 stocks, which is called either a mutual fund or an ETF or an index fund. So these are a cluster of funds. So instead of buying 5 different stocks, you can just buy, let's say you pay $100 to buy that cluster and that is it. You don't have to go and individually buy the stocks. Now, this helps in diversification. That's the best thing about these three investment vehicles, that instead of buying just one single stock, you buy a cluster, which is, instead of finding that needle in the haystack which will really do well, what you try to do is you just buy the haystack. And historically, the haystack has been increasing in value. The stock market has been increasing in value, and it is very difficult for you to exactly know which company will work. For instance, there was a time when GE was one of the most favorite companies. Enron was one of the most favorite companies, and they went down. Enron collapsed. GE has stopped performing the kind of way it was performing before. Apple, no one knew Apple before. No one knew Google like 30 years ago. And suddenly now they are the top market making companies in the stock market. So since it is very difficult for you to exactly know which stock to pick, especially because this is not your day job. For instance, for me, my day job, I have a 9-to-5 job, I have my hobbies, I have passion for YouTubing, I have my family. I don't have the time to study any particular company, their annual reports, knowing what their strategies are, what their future plans are, what is the makeup of their board. You should be knowing all of this if you are going to pick one stock. So it's better for you to pick a cluster of stocks. And if you want to buy a cluster of stocks, then you have mutual funds, index funds, and ETFs where you can buy this. Now, of course, you have the opportunity to select which kind of sector you buy, which kind of cluster you buy. So there are different clusters available within all these three pillars that you have. So this is the commonality. This is what these three pillars stand for. Now, what is the difference? Let's start with mutual funds. Mutual funds are actively managed. So there is one particular financial advisor who is managing that fund. Like he or she is choosing where to invest, where not to invest, how much to buy of Apple, how much to buy of Microsoft, should we stop buying any more Coca-Cola altogether. So they are playing with the asset allocation. So once you buy the fund, once you pay them, let's say $100, they keep reallocating your $100. Because of that reallocation, and they are trying to maximize the return, they charge a higher fee. And usually these fees are in the range of 1 to 2%. Makes sense if there is an individual who is doing the work by actively allocating your fund, then you pay them some fee as well, because that's how they earn their money. Here comes the challenge. The challenge is that historically, and here is the chart, and I will leave the source of this chart in the description of this video as well. Most of the funds, most of the actively managed funds underperform the market average. And here the market average is S&P 500. So S&P 500 historically has been delivering 8 to 10% returns. But on the long run, in 15 years plus, all or most of the actively managed funds underperform the S&P 500, which is their returns are below 8 to 10% that we've seen in S&P 500, which means like I pay them high fee, and on the long run they don't even overperform the market, because if they don't overperform the market, then why do I need so much money that I pay to them in order to reallocate their assets? How about I just go about buying the market myself? And here comes index funds and ETFs at play, which is they allow you to buy the market or buy the cluster funds at a very low cost fee. So index funds and ETFs are passively managed funds, unlike mutual funds, which means there is no particular individual sitting and reallocating the assets. Rather, they are being automatically managed, passively managed. So they just follow an index. Let's say the most common index is S&P 500. So however S&P 500 is performing, these funds or this particular index would perform similarly. So if S&P 500 is going up by, let's say 5%, this index or ETF of S&P 500 will also go up by 10%. Now the beauty here is that since it is passively managed, it is low cost. And it's not just about the low cost. The beauty is that at that low cost, you are able to deliver guaranteed average market returns. Unlike the actively managed mutual funds, which on the long run do not overperform the market average, rather they underperform the market average, you are better off performing as per the market, but at low cost. So I am better off investing in index funds or ETFs because it is low cost and I still get a guaranteed delivery of the average market returns. While mutual funds, they underperform for the most part. It is more risk there and high cost. And here is the difference between the cost. So mutual funds are somewhere between 1 to 2%, while index funds or ETFs cost around 0.03 to 0.05%. It's so low. And here is an example. I'll share with you a comparison if you are paying 2% on a $10,000 investment. So you have a $10,000 investment, you invest it for 10 years and you earn 10% return, both in case of mutual funds, let's say, and in case of index or ETFs as well, you earn 10% return. However, in case of mutual funds, you pay 2% cost, while in case of index funds or ETFs, you only pay 0.03% cost. What would be the eventual gain or loss that you will incur, or the net gain or the net cost that you will incur? You can see it on this chart. So a 10% return at 0.03% cost will give you a net gain of $15,867, while the same $10,000 invested for 10 years giving you 10% return, but at a 2% fee, which will be charged by the mutual fund, would result you in $11,589, which is approximately $4,000 less versus what you would make on an index fund or an ETF just because they are cheap. So you're incurring $4,000 extra because of that 2% fee as against the low fee. So far, I'm sure I have established the fact that mutual funds are not a good buy for you, and hence I don't invest in mutual funds at all. Now let's talk about the difference between index and ETF, because if both of them are low cost, both of them are tracking an index, then what is the difference? The difference is that ETF, being an exchange traded fund, acts like as if you're buying stocks on the stock market. So you can trade them regularly at any given point in time. However, with index fund, you can only purchase them once a day, and then you have to wait for 24 hours for you to trade them again. So you can't actively trade index funds as against ETFs can be actively traded on the stock market. The second key difference or the benefit of index fund is that you can automatically invest on a regular basis, which is you can instruct your online brokerage account to regularly take money out of your cash and invest it in the index fund on regular basis. However, with ETFs, you have to manage them, or you have to buy and sell them on your own and have to manage them yourself as against having an automatic setup. Thirdly, with index fund, you have the benefit of reinvesting the dividends. So whatever dividends are earned on the index fund can be reinvested directly back into the index fund. However, that's not the case with ETFs. With ETFs, you earn the dividends and then either you can take them in cash or reinvest them back in that particular ETF or in some other ETF. So there is more manual work required with managing an ETF as against index fund. So if you are someone who just doesn't want to touch their funds, which should ideally be the case because you should be investing for the long term and not trading in and out and not trading on daily basis, then you should rather invest in the index funds, because the person who invests in the market for the long term always wins. It's not about timing the market, it's about time in the market. And index funds helps you do that because it automatically takes money out of your account and enables you to automate investments. Second, it doesn't allow you to actively trade on a particular day. And third, it reinvests your dividends as well. As against ETF, where you have to kind of actively manage yourself by selling or reinvesting the dividends. So I recommend, if you are someone for the long run, which you should be, then you should go for index fund. However, if you're someone who would like to trade in and out and would like to have a preference of having some kind of control, then ETFs are the better option for you. Hopefully this video was helpful for you to now have a clear idea as to what are the differences between these three kind of investments and which one is good for you. In case you found this video valuable, I'm sure you'll find another video very valuable on my channel where I talk about my financial freedom journey. You can check it out here. Other than that, there is another video on my channel where I talk about how you should go about investing when you see the market dipping. You can check it out here.